This webinar is for educational purposes only, shouldn't be considered legal advice, accounting advice, or investment advice. We're obviously in the space. We talk to lawyers, we talk to CPAs. We're here to transfer that knowledge, but we always recommend that you consult with your own attorney and financial advisors. So now that we got that disclaimer out of the way, let's jump into underwriting. And in order to understand how to underwrite, we first need to understand the three most important metrics that we use in order to analyze a deal and how lucrative it is. So the first one we're going to discuss is a cash-on-cash return. And essentially, cash-on-cash in its simplest terms is, what am I earning year to year? So think like an interest rate. So if somebody says this is a 7% cash-on-cash return, and you invest $100,000 into a deal, that means you should be getting $7,000 a year in cash flow while the deal is active. The downside of cash on cash, it doesn't show you the whole picture. It doesn't show you all of the returns you're going to get, because a big chunk of the money that's made in commercial real estate is when you exit the property. So this just shows you the cash flows along the way, but it's a very important number, and it's more important for some folks than others. So as an example, some deals are a little riskier, and they might not have a great cash on cash. Most of the money might be made when you're exiting that deal on year 3 or on year 5 or year 7, whatever the business plan is. But if you're retiring and you want to replace your income with passive cash flow every month, maybe those type of deals aren't going to be great for you. But the deals that have a high cash on cash, where you know you're going to get X dollars every month or every year, maybe that's going to be a much more important number. So that's a little bit on cash on cash. It's an important metric to know. And as we go through this, I'm going to show you how small changes in assumptions, how it could impact these numbers greatly. So the second is the equity multiple. And equity multiple is essentially how much will I get back in total. So as an example, if something is a 2x return and you've put in $100,000 in capital, that means by the end of the whole period, you should get $200,000 back. If something is, for example, a 2.5x, then that $100,000 should deliver $250,000 back. So equity multiple is a good gauge of how profitable a deal is overall. But the one downside with equity multiple is it doesn't account for timing. It doesn't tell you how quickly you're going to get that return, right? So there's obviously a great benefit to getting your return in 3 years instead of 5 years, right? I'd rather double my money in 5 years instead of 7 years. So if you're ever talking about equity multiple, or somebody's presenting you an equity multiple number, question that you always want to ask is, on what time frame? Obviously, the shorter time frame with the same equity multiple is going to be more attractive than something that is a longer term hold with the same number. And last but not least, actually, I would say is most important, at least for me personally and many people that I talk with, is IRR. And that stands for internal rate of return. Essentially, this is saying, how fast is my money growing? It's really your annualized returns, but it's smarter than that. It adjusts for when you actually get the money back. Not just how much you get, but the speed at which you recovered the money. And obviously, if you're recovering capital quicker, that's going to be less risky, right? Because you're able to take your money back and put it back into your bank account faster. So there's less risk to deals with a better IRR. And also, it's more profitable because you could take that cash flow that's coming in and you could reinvest it. And through the power of compounding, you can grow your wealth exponentially faster. So those are really the three big metrics that sponsors, passive investors should really be very familiar with when they're looking at an opportunity. And now to illustrate an example, I want to show you a little bit more about how IRR works because it's such an important metric. So if you look at this chart, property A and property B, this is both assuming a $100,000 investment. And if you look, it says equity multiple. Both of them are a 2x, right? So on both of these properties, you're going to double your money on a $100,000 investment. However, as you can see, one of them is a 17% IRR, and the other one is a 14.87% IRR. Now, the reason property A is better is because you could see in year one, you're recovering $100,000. The property is getting back $100,000 every year on year one, on year two, year three, year four, and then a $1.6 million on year five. However, on property B, as you can see, there's no distributions in year 1, 2, 3, 4, and just everything comes back all at once. So property A, if everything else is equal, is going to be more attractive than property B as an investment, even though you're still doubling your money on both of these assets. On one of them, the fact that you're able to recoup your investment faster is more attractive because, as I said before, there's less risk to that. And also you're able to take that money and you're able to redeploy it and have that money start making money for you right away. So now that we've kind of covered some of these basics, let's start by looking at how rent growth affects IRR. And this is that first assumption, okay, that you really need to dive into in order to make sure that the deal makes sense. So rent growth is one of the most significant drivers of the financial performance in multifamily investments. Even a small change of 0.5% here, 1% there could make a huge difference in terms of what you get back as an investor on the deal. And if you take a look at this chart that we have, this is looking at an investment and everything else is really equal. And it's showing you on $100,000, here's what your returns would look like. Let's say if this was forecasted at a 4% rent growth a year. And if you see the profit, it shows that on your 100,000, you would make 128,000. Now, if that changes by just 1 percentage point, and if instead of achieving a 4% rent growth, the deal only achieves a 3% rent growth, that 128,000 now becomes 98,000. And if that 4% becomes 2%, if you take a look, that 128 now becomes 70,000. That's almost a $60,000 difference, right? And if you take a look at some of these IRR numbers, right, at 4%, we're almost at 20%, but then at 3%, we're at 16, at 2%, we're at 12. So the point that I'm trying to make is that people can make deals look fantastic, right? Depending on the assumptions that they are putting in their performance, right? I can make any deal look like the greatest deal in the world if I just put in 10% rent growth. But it's not about what you put in. It's about what is most likely going to be a reality. And that's what I want to educate you on today by giving you some questions that you should ask your sponsor, and also a little homework that you can do on your end to ask yourself, the rent growth that is being projected and being presented to me on this deal, does it make sense? So let's go into some questions. So the first is when we're speaking with your sponsor, ask her just a very simple, what is the rent growth assumption that you're assuming for each year? Now, sometimes they're going to assume maybe 2% or 3%, and then on the first couple of years, and then maybe on year 3, they might assume that it jumps up by a percentage point. So you want to hear what they have to say, and you want to write it down. Now, the next thing is you want to ask them, how did you get this data? How did you assume a rent growth of 2% or whatever that number may be? If somebody tells you, this is what the brokers have indicated to us, I'll tell you that's a major red flag. Remember, brokers in this business, their job is to represent the seller. and to sell the property. They want to make a deal look as good and as pretty as possible. A good sponsor's job is to read through all of that, do their own due diligence, and find out what these assumptions should really be. Okay, so remember that as a red flag. Broker assumptions should never be relied on solely. Now, what you should ask for is what data sources are you using? And the big data sources that the industry uses would be either a CoStar report or a Yardi Matrix report. These are the two giants in the industry that perform data analytics on all markets through the US. If somebody doesn't have a CoStar or a Yardi report or some other third party that is known in the industry, that would also be, I would say, a red flag, because without that type of information, it's just impossible to have, it's impossible to have solid and accurate underwriting. So when you get that CoStar report, okay, you want to just take a look for yourself. And what I want to do right now is I want to actually pull up a CoStar report and just show you how that section looks like. So we have Joe on the call with us. Joe, can you go ahead and just pull up a CoStar report? Now, I want to show everybody, you see, we're looking at Houston, Texas. So I just pulled up a big market. Now, you want to make sure that you don't get a whole state or a whole city. You want to make sure you get a submarket report. So if something is in, Arlington, Texas, this report should say, market report for Arlington, Texas. But for purposes of example, I'm just going to use Houston as a main metro. So let's go ahead and take a look at the rent growth. And this is what you should scroll down to, where it says rent. And as you can see, it shows you the history. And then after this 2025, now it shows you the forecast. So there's a couple of things that you want to look at when you're looking at this. So the yellow line is the United States. So now you're able to compare what is CoStar forecasting for the US overall in terms of rent growth for 25, 26, 27, 28. And now you could see in the line where it says the green line, effective rent per unit. Now you could see what they're forecasting for Houston. And you could see in Houston in 2025, they're forecasting just about 2%. In 2026, also another 2%. Then it just starts going up a little bit to about like 2.5%. And then after that, we should start getting back into the 3s and then into the 4%. And that makes perfect sense because right now there's been some supply that hit the market. So that supply needs to be eaten up. So now when you're looking at this report, you as a passive investor, that's kind of the first step of due diligence. You want to make sure that what your sponsor told you on the phone, the numbers you wrote down for year 1, 2, 3, 4, and 5, match the numbers that you look at on CoStar. And obviously, if something is different, then you just need to get on a phone call and ask why, right? So this is how the rent comp section would look like, and something that you really want to kind of zoom in on. Now, besides CoStar, I want to give you some other tools to get comfortable with rent growth assumptions. One of the other big things that you need to ask a sponsor is, how do we compare to the comparable properties in our vicinity? And you want to ask, what is the closest comp? So that should be a question. What is the closest comp to us, that is in similar vintage, same year build, has similar amenities? You want to make sure that you don't get a comparable that was built in, let's say, 2020, but the property you're being presented was built in 1990s. Those can't be comps. It's like comparing apples to oranges. So you want to make sure that the comp that they provide you is going to be similar in vintage and in amenities. You don't want to have one property with pools, gyms, and the other property kind of maybe run down, beat up without any of those amenities. So when you get that comp, you want to start asking a couple of simple questions. Question number 1, how much are we planning to charge for rent on year 1 for our one bedrooms? And how much is this comp currently charging? Just write that number down, whatever it is. Second is same question, but what about two bedrooms? What are the competitors charging for two bedrooms currently? And what are we planning on charging for two bedrooms once we acquire the properties? And if there's three bedrooms, you ask the same question as well. But now what you could do is you could do a little bit of your own research. And this only takes about 5 or 10 minutes. But you have the property name that's been presented to you. And now you have the comp name. So the next thing that you would want to do is you would want to go on apartments.com. And apartments.com is, and we'll show you an example. Apartments.com is where all of these, big properties, they advertise their listings and their units. And now I'm going to show you an example of a deal we were just underwriting. So we're going to pull up a comp. It's called the Luna. Okay. So this was one of the competitors that we would have to the property that we are acquiring. Okay. And as you can see, the first thing I'm doing is I'm just taking a glance. What does this property look like? Okay. What do the units look like? What are the finishes? What are the cabinets? And just overall, even the exterior. What's the exterior look like? Now that I have that feeling, on another tab, I want to open up our property. So Joe, go ahead and open up the property that we were looking at. So this is the Harrison. So now, again, you just want to start scrolling through a couple of photos and asking, how does this property look compared to our property? Now go one step further and start looking at their one bedrooms. Okay, so let's take a look at the Luna, for example. And you could see that over here, their one bedrooms are priced at about $826 to $950 a unit. And you could see the square footage also. So these are 421 square feet. Okay, so I kind of get this range that 826, 950, so maybe I'll put kind of the middle at about $900 they're charging on average. So now I'm going to go and take a look at our deal that we were looking at. And when I look at our one bedrooms, I see currently they're charging $1,200. Okay, I look at the square footage, and now there's 675 square feet. So that kind of makes a little bit of sense to me. Okay, so we are charging more money than the comparable, but it is a bigger property. Okay, but I want to give you an example of when red flags could come up. If this was pulled up, for example, if you looked at this as a passive investor, just quickly, 3-5 minutes on apartments.com, and you saw that the comparable was the same size as the target property, and then the rent was almost $400 more, that would be a major red flag, because it's not just $400 more, it's about 30% more, because if you look at the rental prices there, this is affordable housing. That's a huge jump for people that are making, $35,000 to $40,000 a year. So this is a quick way that you can check this on any property that you're looking at. And you could do the same thing. As you can see, the unit mix here are really one bedrooms and two bedrooms. Then you could click on the two bedrooms. Joe, go ahead and click on the two bedrooms. And you could look, 875 square feet, and they're charging about, on average, $1,275 for each unit. Now, let's jump to the Luna. We click the two bedrooms over here, okay? And we see that they're charging a little less. Square footage seems, I believe, Joe, was that about the same? 660? Okay, it's a little smaller. So it shows that our two bedrooms are going to be comparable. Now, why is this important for rent growth? Because rent growth is about two things. One, what are the projections based on these analytics platforms? They're running complex data sets. They're looking at supply, demand, economy, and they're not 100% accurate, but these are the absolute industry leaders. So that's one. But the other is, where is it priced today? If you're at the top of the market today, if your rents are higher than your competitors today, even if CoStar is showing you that you can grow by 3% a year, you need to take into consideration that, well, hold on a second, our property is priced so high compared to the competitors, we might have a hard time meeting some of these forecasts that CoStar or Yardi Matrix is showing us. So I would say these are the two really big items that you can look into to build some comfort around rent growth. And I'm going to give you one more. Another one is called rent to income. So you want to ask your sponsor, what is the rent to income for this submarket? Okay. And you want to say, what is the rent to income for this 3-mile radius in specific? And what is rent to income? Rent to income is essentially saying, what is the percentage of people's income is going to their rental housing expense? I'm going to give you a couple of rules of thumb. If there's a submarket where there's more than 33% of somebody's income going to their rent, I would be cautious. Now, if it's over 37, 38, even 40%, I would say that is more dangerous. And the reason being is because when so much of somebody's disposable income is going to their housing, it's going to be hard to increase rents. Even if you do increase rents and people can't afford your increases, then people start going delinquent. And that's going to hurt all different types of numbers. Now you have evictions to deal with, turnover costs. So you have to be very careful when you're looking at kind of this whole picture holistically. And last but not least, when it comes down to rent to income, you also want to ask one more question. You want to ask about vacancy. So vacancy is essentially, what is the percentage of units not occupied? So if a property is below 90% occupied, this could be a sign that the prices of the property are too high. Now, not necessarily, right? Because it could also mean that the operations on the property are not running good. But whenever we see something where it's not 90% occupied, those are the first two questions. Is it because it's too expensive, or is it because they're running the property poorly? So the other thing you can do is you can ask your sponsor, what is the vacancy of the comp that you showed me? So now if you're seeing that there's a big vacancy maybe on the comp and on your property, that could be a sign that the rental prices already are kind of stretched out and it might be hard to achieve the forecasts. So like I said, this is not always the case because some properties are just ran poorly. And what would give me a lot of comfort is if I look at our competitor and I see that they're 97 or 98% occupied with the same type of target rents that we're looking for. And let's say even if we're 85% occupied, I'm going to be very comfortable because I see that the comps are able to achieve that. So most likely it's because they're just running the property poorly. And then last but not least, something you should keep in mind is just in general big macroeconomic conditions, especially inflation. So you could ask your sponsor, or you could look at the CPI index, which tracks inflation in the country, or just Google, what are the inflation forecasts? If inflation is forecasted to be high, again, that means people's disposable income is going to get affected. If somebody has to pay more for their eggs, their gas, their basic necessities, then that is a big macro thing that you should be looking at and taking into consideration. Right now, especially in today's economic climate, right now we have a lot of uncertainty with tariffs. Tariffs are very inflationary. So when we're underwriting deals, until this tariff fiasco is we have about 60, 90 days to see how it all pans out. But in the meantime, the deals that we're underwriting, until it does pan out, we're being very conservative on rent growth because if there are going to be inflationary pressures that come out of some of these increased prices, then we have to take into consideration not to put too much stress on our tenants. So I know that's about 5 things that you could do. The first 2 things that I've mentioned, I would say, if you don't have time for all 5, 1 and 2, which is kind of just asking for the CoStar report, asking the broker what they're assuming, making sure those numbers match. That would be top of the list. And then the second one, where you just take a comp, you put it in apartments.com, take a look at what they're charging, what the property looks like, get a feel for it. If you don't have time to do anything else, I could say just by taking some of these actions, you would be 90% ahead of what most passive investors do when they underwrite a deal. So now that we spoke about rent growth, I'm going to talk about cap rates. Okay. And also, I just want to mention, I am talking about the 20% that matter the most. So in life, I believe in Plato's rule. And Plato's rule talks about 80% of our results in life come from 20% of the things we do. The same thing applies to underwriting. There's this 20% chunk that if you don't get it right, you could get a whole bunch of other stuff right, but your deal is not going to be good, right? This is that 20%, which is rent growth. And now the second part of this is going to be cap rates. So let's, I know we may have some folks here that are newer to commercial real estate. So I'm just going to quickly explain what a cap rate is. And then I'm going to explain the difference between what an entrance cap rate is and what an exit cap rate is. So big picture, cap rates across a market are driven by supply and demand, interest rates, and just how risky the market feels that this area is. So as an example, if a market has, higher crime rates, bad schools, if there's not a lot of people moving there, that's usually going to be a higher cap rate market. On the flip side of that, if a market has great schools, if it has a lot of economic stimulus coming in, employers are coming there, people are moving there, those are going to be considered more safer markets, and they're going to have a lower cap rate. Another way to look at a cap rate, it's kind of like a shortcut for figuring out how much buyers are willing to pay for every dollar of property income. It's kind of like a multiplier. So, when companies exit their business, they usually get a multiplier on their EBITDA. So this is kind of our EBITDA for the real estate business, and different markets are going to get a different evaluation. So a lower cap rate means buyers are going to pay more for the revenue that you have on that property. A higher cap rate means buyers are going to pay less. Okay. So besides cap rate, there's 2 caveats to that. There is an entrance cap, and this is the cap rate when you buy the deal. And then there's an exit cap. So this is the cap rate when you plan to sell the deal. Now, the exit cap should always be higher than the entrance cap. And I'm going to go into that in just a second. But first, I want to show you this slide, and I want to show you the impact that exit caps can have on returns and on profitability. So if you take a look here, you see this is based on a $100,000 investment. And we took a hypothetical deal. Everything is the same, right? Rent growth is the same. Expenses are the same. Revenue is the same. All we did was change the cap rate, the exit cap. And as you can see, if we achieve a 5% exit cap, that $100,000 on this deal would generate $98,000 in profit. However, if the 5% didn't materialize and it became a 5.5, that $98,000 drops to $78,000. And if it becomes a 6 cap, that $98,000 becomes a $61,000. I mean, that's almost 40% less in returns. And if you look here on the IRR section, right, the exit cap of 5 gives you a 16, a 5.5 would give you a 13.5, and a 6 would take you all the way down to an 11. So again, I want to stress the point that when people present deals, They can make a deal look bad. They can make a deal look okay. They can make a deal look amazing. It's all depends on what are the assumptions. And the most important thing is to be conservative. So let's take a look at, a little bit. I'll give you a quick rule of thumb. Whenever we have an entrance cap, we want to assume that there is going to be a 10 basis point increase for every year that we hold the property. So if we're holding the property for 5 years and we're coming in at an entrance cap of, let's say, 5, that means the exit cap when we sell the deal should be a 5.5. So that's kind of a quick question you want to ask right away. What is the entrance cap on the deal, Mr. Sponsor, Mrs. Sponsor? What is the exit cap on the deal? If somebody tells you that the entrance cap is a 5 and the exit cap is also 5, there's no increase, there's no spread there, that would be a red flag. If there's anything below 10 basis points a year, you want to ask why. And there might be a good reason for that, right? So let's say, for example, Elon Musk announces that he's moving Tesla to the submarket. That's going to stimulate a lot of economic growth. But unless I see that Elon signed the lease and there's really that type of activity happening, I'm not going to forecast anything under 10 basis points a year. So that's the quick rule of thumb. And if it's anything below 10 basis points, you want to ask your sponsor, why isn't there a big enough spread? Here's a red flag for you. If somebody tells you, well, we expect interest rates to go down because cap rates and interest rates, they have a very direct correlation to one another. When interest rates go down, cap rates go down, the evaluation of real estate property goes up. Here's the thing. You never bank on interest rates going down. Even if every economist in the world is saying interest rates are going to go down, until it actually happens, you don't bank on it. And if it does happen, great. You're going to get much more returns than what you expected. But at least our philosophy at Aligned is we'd rather underpromise and overdeliver than have rosy, optimistic pictures that, for whatever reason, due to market conditions, don't come to fruition. So that is kind of a quick question you want to ask and get some comfort. Now, the other thing that you'd want to do is you want to make sure that your sponsor isn't buying a 4-cap property in a 6-cap market. Because if you're overpaying for a property when you're buying it, it's going to be very hard to make money on it. So here's how you would do that. First, it's about just asking a couple of questions. The first question is, if we're buying this at a 5-cap, Mr. and Mrs. Sponsor, can you tell me what is the name of the comp that traded in the last year? You want to get something at least that sold in the last 12 months. And can you tell me the cap rate that it sold at? So once you get that information, now you have that data. And the next thing you want to do is you want to take that property name and you want to put it into Google. See what it looks like. Look at the pictures on it, or go on apartments.com and compare it to the property that you're looking at. If you're looking at a comp that looks much better than the property you're looking at, let's say it's a newer vintage, it has great amenities, and the cap rate is the same, that would be a red flag. All right, so you want to make sure it's the same vintage and you want to get a couple of comps. So the next thing that you want to do is you want to ask for the CoStar report. But you should have already asked for that when you're speaking about rent growth, so you should have that whole report. And now I want to show you where to go in the CoStar report so you can look at the forecast that some of these major analytics companies are projecting for cap rates. So Joe, if you can, let's just take a look at the Houston market. Okay. So again, we're looking at the Houston market, but if you have a deal in a specific area or a specific submarket, like I mentioned before, you want it to say that specific submarket. You can't just look at a whole market as a huge market like that as a whole. It may not be relevant. And you could see there's a couple of lines here, right? So you have Houston 3-star properties. Okay, so these are some of the older build properties, and it's showing that the cap rates now are trading at about a 6.5 cap. And it shows that by 2028, we should see somewhere around 6.2. By 2029, it's kind of going there, just under 6%. So it is showing that in Houston, cap rates are supposed to decrease. But even if it shows that, you never want to bank on it. You never want to put that in a pro forma. The reason you want to double check this is you want to make sure this arrow is not pointing up. So this is a good sign. It's pointing down. And you could see the whole United States here in yellow. United States in yellow is currently about a 6.2, and it's showing that there's going to be cap rate compression here. So the takeaway here is CoStar is looking at the real estate market as a whole, and it's seeing that things are going to become even more expensive as time goes on. They're probably projecting lower interest rates to come. There's also a very limited supply. I think last time I checked, we're about 3.5 million homes short in the U.S. And now so many people stopped building because interest rates went up. So that shortage is only going to compound. And when you have so little inventory and the population is growing, obviously you have a lot of demand, and that's going to drive not only the prices up, that's going to drive rent growth up. So it's looking like the real estate industry is in for a good couple of years to come, at least based on the forecasts that are being presented by CoStar. So now that we've kind of talked a little bit about rent growth, and we spoke a little bit about cap rates, there's a lot more to underwriting, but I wanted to really cover some of these really big chunks. Again, that 20%, where you can use this as a little cheat sheet. Every time you look at a deal, before you go into all the nooks and crannies, and that just depends how detailed you want to go. If you want to look at high level, big picture things, check these two things. If these things pass and the numbers that are being presented to you look good, then it might be the deal for you. Now, I want to take a minute and I want to show you how this type of discipline and underwriting, the type of results that this type of discipline brings. We entered this space in the absolute peak of the bull run. Interest rates were almost 0%. I think the Fed fund rate was 25 basis points. Money was pretty much free. People were leveraging their commercial assets up to 90%. They were getting 2-year terms. There were bidding wars going on. And, I had all my capital at stake. I'm looking at this. I'm like, these assets are completely undervalued. And obviously it's easier for some folks to maybe deploy that when you're kind of playing with other people's cash. But, if you have a lot of skin in the game, you're going to look at underwriting differently. For us, we had 100% of our skin in the game. So by taking this approach, during this absolute bull run, we only acquired 242 units. However, the results that we got on these units have been outstanding, and it's through some of these disciplines. So I'll show you a quick example here. On Serenity Gardens, we increased the revenue on this property by 36%. We took the net operating income. When we bought this property, it was at $464,000. In 3 years, we took it from $464,000 to $763,000. Overall, when we do exit this deal, we're forecasting a profit of $4.5 million. And we bought it in the absolute peak. We know a lot of folks that bought a lot of deals during these years, and right now they have to give the keys back to the bank or sell it and lose most of their equity. So right now we're seeing a huge buying opportunity. And if we take a look at Sunrise, kind of similar results here. We increased the revenue by 23% in 24 months. So in just under 2 years, we took the net operating income from $293,000 to $572,000. If we were to sell this based on current market conditions, this deal would profit about $3.1 million. So, we did sit on the sidelines for a bit, but now we feel is really the perfect opportunity, as a lot of these operators really over leverage themselves. And now they can't make some of these debt payments after the market has adjusted and interest rates went up. So I'm personally allocating another $12 million of personal capital to invest alongside other like-minded individuals. And our goal is to acquire another $100 million in assets within the next 18 months. Myself and many other industry leaders believe right now is probably one of the greatest investing opportunities in real estate since 2008, assuming and hoping that everything with tariffs doesn't throw a big wrench in that vision. So now that we spoke a little bit about underwriting and how that underwriting can pay off, let's go ahead and jump into some Q&A.
All right, Arnold, this is Joe. We have some questions. First one is, when there is market volatility in the general market, like we've been experiencing, what guardrails should we consider for some of those future projections for rent rates?
Yeah, great question. Yeah, when there's market volatility that's happening now, again, you want to look at some of these things that I've mentioned. You want to look at what is the rent to income ratio for the area already. And personally, we're taking a philosophy right now where we're really looking at B-class properties. And there's a very specific reason for that. The reason we really like B-class properties right now is because the median income on those properties are usually $70,000, $80,000, maybe $90,000. Those are very well protected assets, because if you think about it, if inflation really starts skyrocketing, who's going to get affected the most? The people that are going to get affected the most are people making $30,000 and $40,000 a year. They feel that gas bill much more than people that make $70,000 or $80,000 a year. So we're trying to stay away from some C-class properties. And the reason we like Bs over As is because when the market starts tightening like that, and people that make even $150,000 or $200,000 a year that are in A-class properties, they many times downgrade to B properties because these economic conditions get tight. So some of these protections are, make sure you're focusing on the right asset class, which in our opinion, we're really big fans on the B asset class. And it's to look at some of this data, right? Take a look at what the rent to income ratio is. Make sure that your sponsor is putting conservative projections on rent growth. Take a look at some of these comps. If you put some of these practices into play, you should do very, very well.
Thanks. The next one is, what is the reasonable range for IRR?
Yeah, that's a good question. Reasonable range for IRR for us, we're going to target, if it's anything below 15%, we're going to skip on the deal. So 15%, 17% IRR, those are good returns. But again, with the caveat, conservative underwriting. If somebody is not conservatively underwriting it, they could make something that is a 15 IRR into a 20 IRR. So, our goal is, when we look at sensitivity analysis, we're asking ourselves, if our business plan really goes sideways, can we still make 15% IRR? If the answer is yes, that's a no-brainer. And that's what we go advertise to our partners. And then if we're able to do more than that, because we were able to execute on everything and the winds did blow into our favor, then God bless. We're able to deliver better returns than what we initially promised. So, great question.
What are your thoughts on tariffs related to multifamily?
Yeah. So as I was mentioning, regarding tariffs, they're inflationary. So right now, it's looking like if tariffs stay at 20%, our inflation rate currently, we've been trending. I mean, the Fed did a miracle job. Nobody was expecting the Fed to be able to lower inflation after everything that happened with COVID and not go into a recession. Well, guess what? They did that. We were at almost 7% inflation, and they got it down to 2.5%. It's a miracle. But now, if we end up with tariffs at about 20%, they're forecasting that inflation could go back up, to 4 to 4.5%. Now, if inflation goes back up, the Federal Reserve really only has one tool to combat that, and that is to increase interest rates. If they increase interest rates, usually real estate evaluations go down. So the way we're protecting ourselves is make sure that you're locking in long-term financing. In commercial real estate, that's at least 5 to 7 years. So even if there is some disruption in year one or year two, at least you're protected for a longer period of time. So you give interest rates a chance to go back down. But like I said before, tariffs are inflationary. So you got to make sure that you have good rent to income in the ratio. Rent to income in the neighborhood, and that you're locking in long-term financing on your proposed projects.
What does conservative mean for cap rates on both ends?
So I'm going to assume that both ends means the entrance cap and the exit cap. So it's really market by market. However, if you want to look at it big picture, currently rates today are about 4.5% on the federal level. But from the lenders, you're getting about a 6.5 to 7% rate. So it's hard to justify cap rates of, let's say, a 4 cap or a 4.5 cap or a 5 cap, right? Because there's negative leverage. So there's a caveat to that, because something might be a 5 cap today, but after you've implemented your business plan, maybe it's an 8 cap. So maybe you still want to take advantage of that opportunity. But in today's market, we're not looking at anything below a 5.5. 5.5 would kind of, anything that comes in that's below 5.5, we probably kind of skip right over, unless it has a really good story where, they're running the property really badly, and that's why it's such a low cap rate. And maybe we have an opportunity to come in and really improve operations and bring it up to a 7 to an 8 cap. So that's how I would look at entrance caps today. Exit caps is the same conservative underwriting. I would put 10 basis points a year from whatever the entrance cap is. And the reason for that is you can't really put more than 10 basis points a year, because you're not going to get any deals. The market is still competitive. There's so much institutional investors, so much capital flocking to commercial real estate. Just the way it performed in other recessions, I mean, it's been the golden child compared to other asset classes. So it's still a very competitive market. Deals are still getting bid on. So if you just assume huge cap rates, you're not going to win any deals. So it's about striking that fine balance.
Yeah, the next question was kind of similar to what you were just saying at the end of that answer. And it's, you said add 10 basis points to the entrance cap rate, but isn't a higher cap rate worse than a lower cap rate? So maybe just a little, probably I think what they're looking for is a little clarification on the logic behind it.
Absolutely. Yeah. So a higher cap rate is worse than a lower cap rate. Absolutely. That means a higher cap rate means the property is valued at less. And that's what you want to assume. You want to assume that cap rates are going to go up. You don't want to assume that when you sell the property at the exit, that you're going to sell it for the same cap rate that you bought it for. Now, back in 2020, 21, 22, that's exactly what happened. Cap rates were going down. People made just enormous amounts of money because of market conditions. And that could very well be the case. But when you're underwriting, you always want to assume that things are going to get a little worse. And then if they get better, take that as upside, take that as unexpected reward. But conservatively, yes, you definitely want to make sure you're forecasting a worse exit than an entrance.
Right. How do you know if people will actually pay more rent after you renovate a unit?
Yeah, great question. You really got to look at the comps. So when we walked you through apartments.com, if your sponsor has a business plan of renovating units, you want to take a look at what do our units look like right now? And if they're looking to bump rents by, let's say, 10% or 15%, you want to ask, is there a comp that is charging 10, 15% more than us? And what do their units look like? You want to have a comp that proves your business plan. So if there's another property that's charging higher rents with these type of finishes and renovations, that should give you a lot of comfort that the market is going to respond to the renovations that you're doing. But if there is no comp charging these prices, and if there's nobody else doing these type of renovations, then that would be kind of a red flag of whether or not there's actually demand for these renovated units and whether people are actually going to pay more for that.
Right. We had a few questions about will the presentation be available? So I'll just answer that yes. We will make that available. Otherwise, unless anyone has anything else, happy to answer. If not, I think we're about at the end of our time.
Okay, great. So I'll sign off with saying we're going to have another webinar specifically on tariffs. I know I've kind of mentioned a couple of things today around it, but we're really preparing some heavy research on it, and we really want to deliver you guys as much value as possible. You know, if you enjoyed today's content, obviously, you know, we're not presenting deals. We're just strictly doing this just for education and to build a relationship. The only thing that I ask in return is if you could give us some feedback. We're going to send out a quick survey. Just tell us how we can make it better, how we did, how we could better do our next webinar. We love the feedback, and we are here to serve. And lastly, if you want to chat about any other underwriting strategies and other steps you can take to not only protect your capital, but also grow your wealth, feel free to book a call with any of us. If you send us an email at invest@investav.com, that email goes to me, Tyler, Joe. We all see that email. And just mention who you'd like to schedule a phone call with, and yeah, we'll get something on the books, and we'd love to chat.